One of the main causes of Turkey's economic crisis is President Erdogan's unorthodox policies, such as lowering interest rates in the face of high inflation and interfering with the central bank. These policies have undermined the credibility of the monetary authority and eroded investor confidence in the Turkish economy. Erdogan has a long-term aversion to raising interest rates, which he believes are a tool of foreign powers to exploit Turkey and stifle its growth. He has repeatedly pressured the central bank to cut rates, even when inflation was soaring and the lira was depreciating rapidly. He has also replaced several central bank governors who did not follow his orders, most recently in March 2022. By keeping interest rates low, Erdogan hoped to stimulate economic activity and boost exports, which he sees as the key to achieving current account surpluses and reducing Turkey's dependence on foreign financing. However, this strategy backfired as low rates failed to curb inflation, which reached 80% in July 2023, and led to a widening of the current account deficit due to higher imports and energy costs. Low interest rates also made the lira less attractive for investors and savers, who sought higher returns in foreign currencies or gold. This increased the demand for dollars and euros, putting further downward pressure on the lira, which lost 27% of its value against the dollar in 2023. The weak lira made it harder for Turkish companies and households to repay their foreign currency debts, which amounted to $170 billion at the end of 2022. To prevent a further collapse of the lira, Erdogan resorted to another unorthodox policy, interfering with the central bank's foreign exchange operations. He ordered the bank to sell its reserves to support the lira, depleting them from $40 billion in December 2021 to $13 billion in July 2023. He also launched a scheme called KKM, which compensates depositors for lira losses against foreign currencies, in an attempt to curb dollarization. However, these measures have been costly for the Treasury and the central bank, and have not stopped the lira's slide. Erdogan's unorthodox policies have not only damaged Turkey's economic stability, but also its political stability. His popularity has declined as living standards have deteriorated and basic goods have become unaffordable for many Turks. He faces a tough challenge from his main rival, Kemal Kılıçdaroğlu, who has promised to restore orthodox policymaking and fiscal discipline if he wins the presidential runoff on May 28. Analysts fear that Erdogan's victory could lead to further instability and a severe currency crisis in Turkey. One of the main factors behind Turkey's economic crisis is the sharp depreciation of its currency, the Turkish lira. The lira has plunged in value, reaching a record low of 14.3 to a dollar in December 2021. This means that the Turkish currency has lost more than 40% of its value since the start of 2021, and more than 60% since early January 2021. The weakening of the lira has increased the cost of imports and debt repayments for Turkey, which relies heavily on foreign financing and imports of energy and raw materials. As a result, inflation has soared to over 100% in April 2023, eroding the purchasing power of ordinary Turks and making it harder for businesses and households to repay their debts. The main cause of the lira's decline is the lack of confidence in President Erdogan's economic policies, which have been unorthodox and unpredictable.